All right, so a lot of people talk about QQQI and SPYI. Of course, those are very, very popular ETFs, but rarely do we hear people talking about their sister products, NEOS' sister products with SPYH and QQQH, all right? So today I wanted to do a bit of a comparison between these two products, the QQQIs and the H equivalent, to focus on what is the benefit of the hedge, which is the H, the hedged element to this QQQ product. Of course, they are covered call products, but in this case, they have a hedge or a put to protect you on the downside. So let's look at these products. Let's just jump right into it. All right, guys, so as I mentioned, we talk a lot about SPYI, we talk a lot about QQQI, but what about this product here? What about QQQH and SPYH, all right? And that is NEOS' hedged covered call solution for the NASDAQ 100. Well, what does that mean? What does that mean? Well, you're still going to get your great and tried and true covered call coverage across the majority of the assets. Of course, NEOS, it's their discretion to what degree the assets will be covered by that covered call, whether it's 60% of the market value of the NAV or 100%. That's a bit dynamic, but generally speaking, it's going to be, I think 70 to 100% of the NAV. Now, the distribution rate reflects that, right? We have 9.4% distribution rate against this asset. And if you look at QQQI, that distribution rate is something around 14%. So you're sacrificing a bit of distribution rate here, but you're getting a benefit as a result, all right? And let's look at their targeted benefits for QQQH, and this is going to be similar for SPYH, all right? So the primary benefit with QQQH and the primary difference is going to be the measured downside protection via a fully financed market put, or a market option put, a put against the full portfolio, the full NAV value, all right? That is going to protect this fund from downside. All right, that's going to protect this fund should we drop into a bear market or should we drop into bearish periods. This will not fall down as far. And we can see on red days the comparison between what QQQI does versus what QQQH does to better articulate how this product is hedged, okay? And as I've researched, the put value is at 100% of the net assets under management. So they're giving you 100% put coverage and all this downside protection should the market move downwards, okay? That does cap you and negate your upside by the way of this distribution, but can also improve its price return, as we can see with when comparing QQQH to QQQI. So let's look at that right now. All right, guys, so during down periods, like I said, during moments where we have a decline, I want to show you guys from price return standpoint what happens, all right? And so I've charted SPYH versus SPYI and QQQH versus QQQI, okay? And as you can see here, during periods where the market is declining, you can see SPYH is not declining by the same amount as SPYI, right? So you can see SPYH here declined over the past 5 days by 1%. All right, and SPYI is down by 1.29%, right? So higher volatility, higher downside when it comes to your SPYI or QQQI relative to SPYH. Similar story with QQQH versus QQQI. QQQH less down in the past 5 days, right? Down about, again, 1%. And for QQQI, that is down 1.6%, okay? So during these down periods, we're getting that protection. You're getting that hedge through put options to protect yourself during downside. What happens with a put option? You're gaining because you're betting that the market is going down. You're going to gain value when the market goes down. Now, QQQH and SPYH have only been out since April of this year, March of this year. So they're very, very new. But you can see from SPYI versus SPYH a huge discrepancy, and that's maybe a matter of when when it was created, when in the inception period, because it was during a bear market, during a bear dip, not a bear market, but a bear dip during that moment in April. So I think it would normalize, but since inception, SPYH has done 12%, around 12% over the past 6 months, all right? And SPYI has done 4% price appreciation, all right? QQQH, 6.5%, QQQI, 6.6%, all right? So sometimes maybe SPYH, because of its hedging, is going to do better than its sister in SPYI, or vice versa, just depending on whether we enter more bear markets and are we going to dip down more, all right? In terms of total return, though, this is where you're going to see, generally speaking, better returns from QQQI and SPYI. Should we be more in in a bull market, all right? So SPYH is actually beating SPYI over the past 6 months in terms of total return. Again, this was created right around the time that we had a big dip, so we got to take this with a grain of salt. But SPYI, 12% total return, still phenomenal for the past 6 months. This is just 6 months. SPYH, 16, 17% total return. QQQH, 12.5%. QQQI, 15, 16% total return. So generally speaking, should we be more in a bullish period, bullish patches, we're going to see QQQI be the stronger play, but this will have more volatility. This will have more swings. So if you want something more conservative, if you don't want the bigger swings, and you want even more price appreciation and a more comfortable, a lesser distribution for a bit more price appreciation and hedging against the downside, they're doing a good job with QQQH and SPYH. Yeah, so looking at the distributions, you can't really look at this. This is not accurate because it's been so new. So truly the expected distribution rate for SPYH is 7.89% versus SPYI around 12%, 11 to 12%, really, really strong. QQQH, 8.48% versus QQQI, 13 to 14%. So you can see the distribution, the expected trailing 12-month distribution that you sacrifice with the hedge component, right? Because we have to allocate funds, and allocate assets under management to support that put. And so those cannot be utilized in a sense for usage against the call, right? There's only so many assets that we can leverage, right? Some of it needs to be utilized towards hedging. Some of it needs to be leveraged towards the call, all right? And so you're going to see lesser distribution for SPYH, QQQH, but you're going to have less volatility and potentially better price appreciation on the ETFs, better NAV stability. So if that's the sacrifice, guys, like, do you want less distribution for less volatility and maybe more price appreciation, or do you want to seek the highest distribution possible with your SPYI, QQQI? Just write covered calls against the portfolio and not have any put action on the funds, all right? So that's a decision you can make because you could choose all of these funds, right? And you can mix and match and choose the ones that you prefer, and it's up to your discretion. And this is not financial advice, but you get to choose how you play this. You could have all, you could have one, you could have three, you could have two. It's your call. But the benefit here is you have that flexibility, and I encourage you to read up on the prospectus. I encourage you to read up on the allocations, on the holding section. You can download the Excel that they have. And yeah, so I'd love to get your perspective on this. I'd love to get your comments down below for SPYH and QQQH. Are you investing in these? Guys, let me know in the comments, and all the best and cheers.